The month of June saw some very important global developments, which we believe has not been discussed in detail in India, and we want to elaborate on that. And we are not talking about the easing of tensions in Iran that led to a severe drop in oil prices, which is indeed very, very beneficial for India. Uh, Normally, the global markets and the Indian market should have rallied very strongly on the back of such a positive development. And in fact, the Far Eastern markets in Korea and Taiwan fell in very volatile sessions more than once. And Nasdaq also fell during the month of June. And this was attributed to a certain unwind in the AI trade. We believe one factor uh, that sort of contributed to this development is the new regime in the Fed. We had a new chair in the Fed, and there was a Fed meeting in June, and he held a post-meeting commentary. And this is worth elaborating on. The new Fed chair is widely acclaimed for his intellectual heft, but he was also appointed by a U.S. president who has made his intentions and his preferences for the Fed and interest rates publicly known. He has been putting a lot of pressure on the previous Fed chair to ease rates, and he nominated Kevin Warsh. And Kevin Warsh, in his first post-meeting commentary, uh, made it clear that he would prioritize Fed independence and credibility. He made it clear that price stability is a big priority for the Fed. We all know that price stability and employment are the twin mandates for the Fed. And he reiterated this. He did not necessarily signal higher rates or higher rates for longer, but he signaled a certain preference or a move away from too much of reliance on forward guidance from the Fed. He has been a critic of that. He quit the Fed in 2011, protesting against QE. Since then, he has voiced concerns over asset price inflation. He has spoken about the impact of asset price inflation on capital misallocation. And, uh, and putting all this together, he seems to have made his intentions known very early in his 4 year stint that he would root for Fed independence and Fed credibility, and he would be data driven. Now, the markets will price this in because over the last 35 years or so, successive Fed governors have been widely viewed as very dovish for towards equities and equity markets. Whenever there was a big crisis in the equity market, they've cut rates. And on the other hand, when equity markets overheated, they've stayed away from action on the pretext that equity markets are not part of their mandate. Now we are seeing a development where the new Fed chair has indicated that he would focus on the Fed mandate, which is to say that next time there is a crisis in the equity market, the Fed put would not work and it has possibly expired. And this is a very important development for the global markets, and I think the global markets are trying to price this in as we speak. This has important ramifications for India too. We believe that the valuation re-rating we saw in equities in the last 15 years and in the last few years was in large measure fueled by the gush of liquidity we saw come into the economies around the world. Um, this was not the result of Indian cost of capital of interest rates going down too much. It was a result of the global cost of capital going down and people viewing that it will remain near zero for a very long period of time. Uh, this has now structurally, there has been a reversal in it. In other words, the Indian markets have been driven by liquidity wearing the costume of earnings growth or macro-led growth, which was tepid for a long period during uh, for various periods during this long 15-year period. And therefore, We believe FPIs going forward will take this into their framework while looking at Indian valuations. We also believe the Indian investors will be forced to look at it as we go forward. This reset comes at a particularly inopportune moment for India when we are facing economic challenges of our own. And therefore, we think this is something that needs to be studied in detail and taken note of. I've given a detailed take on the possible impact of the new Fed regime on equity market valuations around the world and indeed on India. But this is not a good timing indicator. The way this plays out on Indian valuations may be visible over the next many weeks or maybe much longer. And therefore, in our portfolio construction approach, the central driving force is earnings and earnings outlook. Let's take banks first. There was apprehension over the last few months that there will be an asset quality impact emanating um, from the Gulf War. However, we believe this may not this fear may be exaggerated. Now that the conflict has eased and oil prices have come down, banks will be able to handle the asset quality impact. Useful to note that earnings impact is very different from credit impact, and banks will be able to manage the situation now that oil prices have eased considerably. On the other hand, these events are positive for credit growth as inflation is at least initially positive for credit growth, as credit growth is a nominal measure, and the spike in tensions has elongated working capital cycles, and therefore credit demand has been picking up. So banks look amongst the most reasonably valued in our universe. The second area where we have deployed capital is in healthcare. During the whole of last year, we have seen fears expressed that tariffs would be imposed. It's pertinent to note that not even 1% tariff was imposed on Indian pharma so far. That tells something about the competitiveness of Indian pharma in the US market and elsewhere. We believe the moats are very strong, and this is amongst the most reasonably valued pockets in the Indian market. So, pharma and healthcare continue to be a key focus area for us. We've also been talking about energy security as a long-term theme. This has been enhanced by the developments around the Gulf War. We see very reasonable valuations over here. There's not been too much momentum on stocks in the recent weeks, but that's an opportunity for us to get invested. As we see this valuations as being very reasonable, and this is a sector that would be least impacted because of macro concerns. Then we have exposure to select small and mid caps. We continue to be very, very wary of small and mid cap valuations in India. There is momentum behind these stocks, but not too much of valuation safety. However, in the short run, we believe that earnings visibility and delivery might take precedence over valuations. And we've taken all of this into account in our portfolio positioning. Uh, the central pillars of our approach remain earnings visibility and earnings resilience.